Greetings, corporate finance. We're starting with chapter 3. And chapter 3 is an introduction to the time value of money. Time value of money. The outline for chapter 3 are cost-benefit analysis, market prices and the valuation principle, the time value of money and interest rates, and valuing cash flows at different points in time. The learning objectives are identify the role of financial managers and competitive markets in decision-making, understand the valuation principle and how it can be used to identify decisions that increase the value of the firm. 3, assess the effect of interest rates on today's value of future cash flows and calculate the value of distant cash flows in the present and of current cash flows in the future. Cost-benefit analysis, the role of financial manager. We all know that financial managers make decisions on behalf of the firm's investors. For good decisions, the benefits must exceed or should exceed the costs. As financial managers, your role extends beyond numbers and spreadsheets. Real-world opportunities in finance often require a multidisciplinary approach, and you will find yourselves going into areas beyond traditional financial expertise. These are some of the skills that financial managers must have. One is marketing skills. Marketing skills are crucial because as financial decisions are intertwined with market dynamics and customer behavior, it is important for financial managers to have this skill. The other one is economics. Now, understanding economic principles helps financial managers in navigating the broader economic landscape, influencing financial strategies. Organizational behavior. Financial managers must have organizational behavior knowledge because it is essential for effective teamwork and leadership within the financial department. And definitely strategy or strategic thinking, because it is paramount in aligning financial goals with overall business objectives. And finally, financial managers must have some operations expertise because it is necessary to ensure the efficient execution of financial plans. So embracing these interdisciplinary skills will equip financial managers to tackle the diverse challenges that financial management presents in the dynamic business environment. Quantifying costs and benefits. Any decision in which the value of the benefits exceeds the cost will increase the value of the firm. Imagine a jewelry manufacturer considering a trade of 400 ounces of silver for 10 ounces of gold. So at first glance, comparing the raw quantities might be misleading because the value of an ounce of silver differs from that of an ounce of gold. So to make a meaningful comparison, what we must do is that we need to quantify their values in equivalent terms. And that's often represented in cash. By determining the respective cash values of the silver and gold, we can accurately assess the trade's cost and benefit. Now, this approach ensures a fair comparison, allowing the manufacturer to make informed decisions based on the actual financial worth of each metal in the context of the trade. If the current market price for silver is $25 per ounce, then the 400 ounces of silver we give up has a cash value of 400 ounces of silver times $25 divided by ounce. And that will give you $10,000. Let's look at gold. Assume gold can be bought and sold for a current market price of $1,900 per ounce. Then the 10 ounces of gold we receive has a cash value of 10 ounces of gold times $1,900 divided by ounce, which will give you $19,000. Therefore, the jeweler opportunity has a benefit of $19,000 today and a cost of $10,000 today. In this case, the net value of the project today is $10,000 minus $4,000 equals $6,000. Because it is a positive number, the benefits exceeds the costs, and the jeweler should accept the trade. A competitive market is characterized by the ability to buy and sell a good at the same price. Within such market, the price serves as the detriment of the goods value. In this context, personal opinions about a fair price become irrelevant. The competitive market setting underscores the importance of objectivity, assessing the market-determined prices when quantifying costs and benefits. Here we have a problem. Example 3.1, competitive market prices determine value. You have just won a radio contest and are disappointed to learn that the prize is 4 tickets to the Def Leppard reunion tour, the face value of $40 each. Not being a fan of the 1980s power rock, you have no intention of going to the show. However, the radio station offers you another option. 2 tickets to your favorite band's sold-out show. The face value is $45 each. You notice that on StubHub, tickets to Def Leppard show are being sold for $30 a piece, and tickets to your favorite band show are being bought and sold at $50 each. What should you do? Here's the solution plan. Market price is not your personal preference, or the face value of the tickets are relevant here. 4 Def Leppard tickets at $30 a piece. 2 of your favorite band's tickets are $50 a piece. You need to compare the market value of each option and choose the one with the highest market value. To execute, the Def Leppard tickets have a total value of $120. That's 4 times the $30. Versus $100 total value of the other 2 tickets, which was like $50 each. So instead of taking the tickets to your favorite band, you should accept the Def Leppard's tickets, sell them on StubHub, and use the proceeds to buy 2 tickets to your favorite band's show. You'll even have $20 left over to buy a t-shirt. Let's evaluate. Even though you prefer your favorite band, you should still take the opportunity to get to get the Def Leppard's tickets instead. As we emphasized earlier, whether this opportunity is attractive depends on its net value using market prices. Because the value of Def Leppard's ticket is $20 more than the value of your favorite band tickets, the opportunity is appealing. Here we have another problem. Your car recently broke down and it needs $2,000 in repairs. But today is your lucky day because you just won a contest where the prize is either a new motorcycle with MSRP of $15,000 or $10,000 in cash. You do not have a motorcycle license, nor do you plan on getting one. You estimate you could sell the motorcycle for $12,000. Which prize should you choose? Market prices, not your personal preference, nor the face value of the tickets, are relevant here. A motorcycle worth $12,000 or $10,000 cash. You need to compare the market value of each option and choose the one with the highest market value. Instead of taking the cash, you should accept the motorcycle, sell it for $12,000, use $2,000 to pay for your car repairs, and you still have $10,000 cash left over. Let's evaluate. As we emphasized earlier, whether this opportunity is attractive depends on its net value using market prices. Because the net value of taking the motorcycle and selling it is $2,000 more than taking the cash, the opportunity is appealing. Market prices and the valuation principle. 3.2, the valuation principle. So according to the valuation principle, the worth of a commodity or asset to a firm or its investors is determined by its competitive market price. When making decisions, it is crucial to evaluate the benefits and costs using these market prices. If the value of the benefits surpasses the value of the cost, the decision is expected to enhance the market value of the firm. Essentially, the valuation principle guides us to base our assessments on objective market prices, ensuring a comprehensive understanding of the potential impact of decisions on the firm's overall value. Here we have a problem. You are the operations manager at your firm. Due to a pre-existing contract, you have the opportunity to acquire 200 barrels of oil and 3,000 pounds of copper for a total of $25,000. The current market price of oil is $90 per barrel, and for copper is $3.50 per pound. You are not sure that you need all the oil and copper, so you are wondering whether you should take this opportunity. How valuable is it? Would your decision change if you believe the value of oil or copper would plummet over the next month? Let's see. First, we need to quantify the costs and benefits using market prices. We are comparing $25,000 with 200 barrels of oil at $90 per barrel, 3,000 pounds of copper at $3.50 per pound. Using the competitive market price we have, 200 barrels of oil times $90 divided by barrel today, which will give us $18,000 today. 3,000 pounds of copper times $3.50 divided by a pound today will give us $10,500 today. The value of the opportunity is the value of the oil plus the value of the copper less the cost of opportunity. So you have $18,000 plus the $10,500 minus $25,000, which will give you $3,500 today. Because your number is positive, you should take it. This value depends only on the current market prices for oil and copper. If we do not need all of the oil and copper, we can sell the excess at current market prices. Even if we thought the value of oil or copper would drop soon, the value of this investment would be unchanged. We can always exchange them for dollars immediately at the current market prices. Here we have another problem. You are offered the following investment opportunity. In exchange for $50,000 a day, you will receive 2,500 shares of stock in the one company and €10,000 today. The current market price for one stock is $14 per share, and the current exchange rate is $1.12 per euro. Should you take this opportunity? Would your decision change if you believe the value of the euro would rise over the next month? Solution plan. The costs and benefits must be converted to their cash values. Assuming competitive market prices, you have the 2,500 shares times the $14 divided by share, which will be $35,000. Then you have the $10,000 times $1.12 divided by euros will give you $11,200. To execute, the net value of the opportunity, $35,000 plus $11,200 minus the $50,000 will give you $3,800. We should not take it because it's a negative $3,800. Evaluate. This value depends only on the current market prices for won and the euro. Our personal opinion about the future prospects of the euro and won does not alter the decision today. This decision is not good for the firm and will decrease its value by $3,800. Market prices and the valuation principle. Why there can be only one competitive price for a good. The law of one price. So the law of one price principle asserts that in competitive markets, identical goods or securities must share the same price. In a broader sense, if two securities yield precisely the same future cash flows, they must also have the same price. The law of one principle reflects the efficiency and fairness inherent in competitive markets. The idea is that in well-functioning market, no opportunity for risk-free profit should exist due to price disparities for identical items. So the law of one price is a foundational concept in financial theory because it emphasizes the role of market competition in assuring consistency in pricing for equivalent goods or securities. Engaging in buying and selling of identical goods in different markets to exploit price differentials is termed as arbitrage. So again, engaging in the buying and selling of identical goods in different markets to exploit price differentials is called arbitrage. So an arbitrage opportunity would be any circumstance where profit can be generated without assuming risk or making an initial investment. So given that the benefits of an arbitrage opportunity outweighs its costs, investors would swiftly act to capitalize on these opportunities in financial markets. The ensuring trades executed by these investors work to eliminate the arbitrage opportunity, whereby reinforcing the efficiency of financial markets. 3.3, the time value of money and interest rate. $1 received today is worth more than $1 received in 1 year. If you have $1 today, you can invest it now and have more money in the future. For example, if you deposit in the bank account paying 10% interest, you have $1.10 at the end of 1 year. So we call that difference in value between money today and money in the future the time value of money. Here you see a timeline. This diagram compares the time value of money between today and 1 year. So if you read it from left to right, and above the line, you see at the left today, there's a negative $100,000. To your right, there's a positive $105,000. And below the line, the diagram you see here, there's a negative $1. But in 1 year, you'll have a positive $1.10. Okay? So you see here that the arrow points to a positive $1.10 from the negative $1. Here's another diagram that shows 3 rectangulars, which represents dollars today, dollars in 1 year, and ounces of gold today. Dollars today convert into dollars in 1 year with interest, and dollars in 1 year convert into dollars today before interest. To convert dollars today into ounces of gold today, you would divide, right? You would divide gold prices by dollars today. To convert ounces of gold today into dollars today, you would multiply gold, or the gold price, by the price of gold in dollars per ounce. Through deposits, we transform present money into future funds. By borrowing, we swap future funds for immediate cash. The interest rate, which is indicated by the letter R, it signifies the rate at which money can be borrowed or lent over a specific duration. The interest rate plays a pivotal role in our financial world. It influences the cost of borrowing and the return on investment. The interest rate factor that you see here, the 1 plus R, 1 plus interest rate, it is a key component in understanding the exchange rate between dollars today and dollars in the future. Now, this factor encapsulates the relationship between present and future values of money, considering the impact of interest rates. So it is a crucial element in financial calculations because it helps us assess the value of money across different time periods. And it also helps us make informed decisions regarding borrowing, lending, and investments. The interest rate converting cash across time. Here you see the value of $100,000 investment in 1 year. If the interest is 10%, the cost of the investment is cost equal $100,000 today times $1.10 in 1 year divided by $1 today, which will give you $110,000 in 1 year. In this diagram, you see the interest rate converting cash across time, the value of $100,000 investment in 1 year, $110,000 is the opportunity cost of spending $100 today. The firm gives up the $110,000 it would have had in 1 year if it had left the money in the bank. Alternatively, by borrowing the $100,000 from the same bank, the firm would owe $110,000 in 1 year. The interest rate converting cash across time. The value of $100,000 investment in 1 year. The investment's net value is difference between the cost of the investment and the benefit in 1 year. The $105,000 minus $110,000 will equal a negative $5,000 in 1 year. And this diagram is comparing the cost and benefit of a 1 year investment. So the value of $100,000 investment today, how much would we need to have in the bank today so that we could end up with $105,000 in the bank in 1 year? And this is calculated by dividing by the interest rate factor. So the value of $100,000 investment today, the investment's net value today is the difference between the cost of the investment and the benefit in 1 year. So you have the $95,454.55 minus $100,000 equal a negative $4,545.55. Present versus future value. So the present value, you have the value of a cost or benefit computed in terms of cash today, which is a negative 45, 45, 45. The future value, which is the value of a cash flow that is moved forward in time, you have the $5,000 minus the negative 45, 45, 45 today times $1.10 in 1 year divided by dollars today will equal a negative $5,000 in 1 year. If the interest rate, converting cash across time, discount factors and rates. Money in the future is worth less today, so its price reflects a discount. Discounted factors and rates. Discount rate, the appropriate rate to discount a cash flow to determine its value at an earlier time. Discount factor, the value today of $1 received in the future. The 1 year discount factor is expressed as 1 over 1 plus R. Here we have a problem. The launch of Sony's PlayStation 3 was delayed until November 2006, giving Microsoft Xbox 360 a full year on the market without competition. Sony did not repeat this mistake in 2013 when PS4 launched at the same time as Xbox One. Imagine that it is November 2005 and you are the marketing manager for the PlayStation. You estimate that if PlayStation 3 were ready to be launched immediately, you could sell $2 billion worth of the console in its first year. However, if your launch is delayed a year, you believe that Microsoft's head start will reduce your first year sales by 20% to $1.6 billion. If the interest rate is 8%, what is the cost of a delay of the first year's revenues in terms of dollars in 2005? The problem solution plan. Revenues, if released today, $2 billion. Revenue, if delayed, $1.6 billion. The billion interest rate, 8%. We need to compute the revenues if the launch is delayed and compare them to the revenues from launching today. However, in order to make a fair comparison, we need to convert the future revenues of the PlayStation if they are delayed into an equivalent present value of those revenues today. Let's execute. If the launch is delayed to 2006, revenues will drop by 20% of $2 billion or $400 million to $1.6 billion. To compare this amount to revenues of $2 billion, if launched in 2005, we must convert it using the interest rate of 8%. And here you see the formula. 1.6 billion in 2006 divided by $1.08 in 2006 divided by $1 in 2005 equal 1.6 billion over 1.08 equal $1.481 billion in 2005. Therefore, the cost of a delay of 1 year is $2 billion minus $1.481 billion equal $0.5119 billion or $519 million. To evaluate this, Delaying the project for 1 year was equivalent to giving up $519 million in cash. In this example, we focus only on the effect of the first year's revenues. However, delaying the launch delays the entire revenue stream by 1 year. So the total cost would be calculated in the same way by summing the cost of delay for each year of revenues. Here we have a problem, another problem. The cost of replacing a fleet of company trucks with more energy efficient vehicle was $100 million in 22. The cost is estimated to rise by 8.5% in 2023. If the interest rate is 4%, what is the cost of a delay in terms of dollars in 2023? Here's our plan. We need to compute the cost if the replacement is delayed and compare them to the cost from replacing today. However, in order to make a fair comparison, we need to convert the future costs of waiting a year into an equivalent present value of those costs today. To execute, if the project were delayed, its cost in 23 will be $1 million times 1.085, which is $108.5 million. Compare this amount to the cost of $100 million in 22 using the interest rate of 4%. You have the $108.5 million divided by 1.04 equal $104.33 million in 2022. So the cost of a delay of 1 year would be $104.33 million minus $100 million equal $4.33 million in 2022. So to evaluate, delaying the project for 1 year was equivalent to giving up $4.3 million in cash. Here we see a timeline that shows cash flow. Constructing a timeline, identifying dates on the timeline. So you see date 0 is today. And yes, date 0 is today, the beginning of the first year. And then you have date 1 is the end of the first year. Okay. And then you have date 2, which is the end of the repayment period. This diagram shows a cash flow of $10,000. In this timeline, it shows cash flows, date 0, cash inflows has a negative $10,000, right? Date 1, you see there's a cash flow in dollars of $6,000. Then date 2, you see a cash flow of $6,000. So year 1 is between date 0, right, and 1, and year 2 is between date 1 and 2. Rules. Well, rule 1, comparing and combining values. Rule 1, it is only possible to compare or combine values at the same point in time. Rule 2, compounding. To calculate a cash flow's future value, you must compound it. You must compound it. Okay? Here you see the formula for future value of a cash flow. Okay? future value of a cash flow. All right, so the following bar graph, which is on the next screen, it will show how the current balance, account balance, and the composition of the interest changes over time when an investor starts with an original deposit of $1,000, represented by the red area. Okay. In an accounting earning 10% interest over a 20-year period. The green middle bars, oops, sorry. These right here. Shows the effect of simple interest as interest earned only on the initial deposit. The blue top bar shows the effect of a compound interest where interest is also earned on prior interest payments. Over time, the effect of compounding is more pronounced, and by year 20, simple interest is only $2,000, whereas interest on interest is $37,2750. And this is the end of part 1 of chapter 3. Part 1 of chapter 3. We will continue part 2 in another video. Thank you.